Welcome back to Talk Tickers, where we dive deep into the earnings calls that are moving the market. Today, we're looking at Post Holdings and a situation that trips up a lot of investors. It's what we call the classic earnings beat trap.
So, Post Holdings drops its Q4 earnings report. And bam, this is what happens. The market just hammers the stock, sending it down more than 7%. Not just a little dip either. It actually touched a new 52-week low. Ouch. Now, here's where it gets confusing, right? Because on the surface, the numbers actually looked pretty solid. Post-earnings expectations. So what gives? Why the huge sell-off? Well, that's exactly what we're going to unpack. Let's figure out what the pros on Wall Street were seeing that maybe the headlines missed.
Okay, so first things first, let's look at those headline numbers. This is really where you start to see the conflicting story take shape. And wow, take a look at this. This is where it gets pretty wild. That adjusted EPS number, $2.09. That's a huge beat over what Wall Street was expecting. And look at the adjusted EBITDA, up a whopping 22%. That looks great. But then you start looking closer. Revenue, a little light. And then the big one, GAAP EPS, the official number, actually dropped by more than 30%. So yeah, a really, really mixed bag here.
So this really lays out the whole conflict, doesn't it? On one hand, you've got this awesome-looking EPS beat, almost 9%. That's the good news. But the bad news just totally swamps it. Revenue was a miss, and the real problem, the thing that matters most for a company like this, their core organic volumes, basically how much stuff they're actually selling, just fell off a cliff.
All right, so to really get what's going on here, you have to understand that Post isn't just one monolithic company. It's really more like two different businesses under one roof. And this quarter, man, did they tell two very different stories.
And this chart just says it all. You can see right here where the growth came from. It wasn't across the board. Nope. It was almost entirely driven by two segments, Foodservice and Refrigerated Retail. They were on fire. But look at that other slice, the post-consumer brands. That's the cereal, the pet food. It was a huge drag on everything.
Let's talk about the good stuff first. The food service business was the absolute MVP this quarter. I mean, look at that. Adjusted EBITDA up almost 50%. Volumes were up over 9%. They were just crushing it with egg and potato products. And they got a nice little tailwind from some weirdness in egg pricing related to the avian flu.
Okay, now let's flip the coin and look at the other side of the company, because this is where the story gets ugly. That core consumer business, the cereal you see in the store, it wasn't the growth engine. It was an anchor. Organic volumes were down a staggering 11.5%. And if you dig into that number, it's even worse than it sounds. Cereal volumes alone, down over 8%. Pet food, down more than 13%. They're just getting killed by heavy promotions from competitors, their Nutrish brand is weak, and they lost a key private label customer. This, right here, this is the long-term weakness that has the market so spooked.
And there was another little red flag buried in the report. Remember that ugly GAAP earnings number? Well, this is a big reason why. They took a nearly $30 million goodwill impairment. Now, that sounds like accounting jargon, and it is. But what it really means is management is basically saying, hey, you know that dairy business we bought? Yeah, it's not worth what we paid for it. It's a quiet admission of a mistake.
So that's what happened last quarter. But as you know, the market doesn't care about the past. It cares about the future. And that brings us to maybe the most important part of the whole earnings call, the guidance.
And there it is. This one quote from the CFO was the nail in the coffin. He said they expect Q1 EBT to decrease meaningfully. Look, when a CFO uses a word like meaningfully, that's not just casual language. That is a giant, flashing red light for Wall Street.
So why the sudden pessimism? Well, they were actually pretty upfront about it. First, that big benefit they were getting from high egg prices, that's going away. Second, they're bracing for a seasonally slow quarter for cereal. When you put it all together, they're guiding to a pretty meager 1 to 4% EBTI growth for the whole next year. Okay, but it's not all bad news. There is a silver lining here, and this is the core of the bull case for the stock. Post has been spending a ton of money on capital projects, CapEx as they call it. That spending is about to come way down next year. And less spending means one thing. A whole lot more free cash flow is about to be unleashed. And they're already showing what they're going to do with that cash. 6.4 million shares. That's how many shares they bought back just last year.
To put that in perspective, they took more than 11% of their own company's stock off the market. That is a huge vote of confidence and a massive return of capital to shareholders. It's a really big deal. And this really boils it all down to the big question, doesn't it? Is the market totally overreacting to one bad quarter of guidance? Or is it correctly sniffing out a much deeper, long-term problem in the business? Is this a value trap or a buying opportunity? All right, so we've weighed the good, the bad, and the ugly. Here's our official take. Our next call on Post Holdings. So here's how we see this playing out. Step 1. The next quarterly report is going to be soft. No surprises there, they already told us it would be. Step 2, because of that, the stock is probably going to be dead money for a while, just treading water near these lows until the market sees some real proof that those volume declines have stopped. Which brings us to step 3, our rating. We're calling it market perform. Now, what does market perform mean? Basically, we think the stock's going to do about as well as the overall market, like the S&P 500 over the next year. You've got this awesome free cash flow story, and the buybacks acting as a floor under the stock price. But you've also got those nasty volume declines acting as a ceiling. The bull case and the bear case are just in a dead heat right now. Now, for those of you looking for a more specific idea, here's one to think about. A pairs trade. You could go long Post stock, but at the same time short a competitor that only sells cereal. The idea here is to cancel out the risk from the struggling cereal category itself and instead make a pure bet on Post's biggest strength, its diversification, especially that awesome food service business.
And as always, just a reminder that this is not financial advice.